The topic today is corporate valuation and financial planning. And look at the little comic strip here. As you can see, we've been recapitalized. You're going to be learning about recapitalization in corporate finance if you move on to that course. It is the method by which companies change their debt to equity ratio through various mechanisms. But today we're going to look at valuations. All right, topics. First, financial planning generally. Second, the additional funds needed calculation, which is a very handy calculation to make to look at what is the limits that the company can grow without any dramatic changes in their financial structure. Third, we'll do some forecasting. We'll do a fairly extensive example, first with less than stellar performance, and then a critique of the results, and then a modification of those results to lead to better results. The reason we go through this sequence is it's likely that you will see this in the future, where your first pass doesn't really get you where you want to go or doesn't get the company where it wants to go. And you have to find ways to be more creative or aggressive in revenues or cost management. Then we'll look at some changing ratios and how those could tweak the results so that we can find the results that we're seeking. So first we'll look at an overall view of how projections fit into the overall picture. You'll see this is an expanded portion of that same flowchart. What's familiar is the bottom light blue box where we start with free cash flow projected into the future, and we divide it by 1 plus the weighted average cost of capital raised to the power of the number of years. But what precedes it is a little bit more precise. At the very top, we look at forecasting, where we look at the company's strategy and know what we're trying to do and where we've been. Those will then inform assumptions that we make that will drive the income statement, the balance sheets, and identify surpluses or deficiencies in cash. That leads us perhaps to iterate through some adjustments to the assumptions, or once we're set, we can then move on to free cash flow, which then goes directly into our valuation model. So as far as the process is concerned, we will start with the forecasting. Then we'll get to a free cash flow and valuation, which will then lead to a preliminary estimate of the stock price. Often that would lead to judgment whether that is good enough. And in our example, it will not be good enough. And then we'll determine the amount of financing necessary to support the plan if no other changes were made. The example we're going to use is called Hatfield, and we're going to look at these statements, and they have a calendar year end. This is for 12/31/2016. Balance sheet on the left, income statement on the right, and some stock information on the bottom right. It's a simple balance sheet where we have cash, receivables, inventory as current assets, and then fixed assets leading to total assets. On the liabilities section, we have our normal accounts payable. We have a line of credit that's available, but we have not yet drawn upon that line. And we have long-term debt that is stable, let's call it term debt, like 5-year term. And common stock only, no preferred, and we have retained earnings. So a very simple balance sheet, but the methods that we use could be applied equally well to a more complex balance sheet, such as the company that you're analyzing. On the right side, income statement likewise will have a very simple income statement with sales, operating cost that excludes depreciation, EBIT, interest, pre-tax, and then net income. On the bottom right, we show the dividend history. We have $20 in dividends, and the other information necessary are the common shares outstanding of 10, and these dollars are in thousands, and earnings per share of $6.60, dividend per share of $2, which is simply the dividends of $20 divided by 10 is $2 per share. And the ending stock price as of 12/31/2016 is $52.80. So all of this is just base data that we're going to then use to do our projections and our valuation. Selected data, I'm looking at Hatfield versus the industry, and this would be again similar to your analysis of the industry, competitors, and your historical performance. So it looks at the Hatfield operating cost versus sales, and we see we're not as good as the industry. We're more expensive. We're at 90% of sales, and the industry is at 88%. Depreciation as a percent of fixed assets is 10%, similar to the industry at 12%. Cash to sales, we're right at the industry average of 1%. Receivables, looks like we're not managing our receivables quite as well. We have more of our assets tied up in receivables than our competitors or industry. Inventory, same thing. It looks like we're not as efficient there, having more sales, more inventory than our competitors per dollar of sale. Fixed asset, likewise, we tend to have more fixed assets. So by and large, if we look at these first measures, which are asset-based, we are running not quite as lean as the industry at large. On the liability side, on the payables, we look okay at 4%. Tax rate is 40%. ROIC, we're less profitable. That should not surprise us. It does not seem like we're performing very well. Next, no patent percent of sales, 4.5 versus 5.6, again, lagging the industry. Total operating capital to sales, we're at 56 versus 45. So we have a higher asset requirement than does the industry, which again is not favorable. We'd like to be lean rather than have more assets in order to generate the same amount of sales. So total liabilities to asset, which is a measure of our capital structure, is 48 versus 36, which means we have more debt than the industry. Times interest earned, we're at 3.8 versus 8.9. Again, that's not as good as the industry. If we have more debt and less profits, we're going to have a worse TIE. Profit margins and return on assets both are lagging the industry. Our efficiency of running assets, total asset turnover, 1.6 versus 2.04, again lags the industry. And the assets to equity multiplier shows that we have more leverage. For every dollar of equity, we have $1.9 of assets compared to the industry at 1.58. ROE is low and the PE also is low. So in terms of overall picture we're getting of Hatfield, Hatfield is not a particularly efficiently run company. It has more assets than the industry. It's lagging in profitability, and therefore all the market-based measures such as PE ratios and all the summary measures of profitability are all lagging the industry. But we have a bit of a tough go to work with in Hatfield. All right, so let's do a little bit more analysis to dig in to where and why the results are as they are. DuPont is the simple and handy way to do that. So if we compare Hatfield to the industry, we have an overall return on equity of 10.6 versus 16.1 for the industry. When we break it into the three components, we lag on the profit margin, 3.3 versus 5. We lag on the turnover, 1.67 versus 2. And we make it up, if you can call it that, with more leverage at 1.9 versus 1.6. Now, I said if you can call it that because we would rather increase our ROE based on kind of performance, based on profits or asset turnover. If we increase it based on leverage, that's not exactly a good method because we're increasing the risk of the company. We're looking at these measures and we see we have a bit of road to go.